So we have the basic information here for the problem, and we're told that there's common stock with a $20 par value. 80,000 shares are issued and outstanding. And what we mean by that is they have been sold, those 80,000 shares have been sold, and none of them have been bought back by the company to be held in treasury. So those full 80,000 shares are owned by investors. To come up with the $1.6 million, we would take the par value of 20 and multiply by the 80,000 shares. Paid-in capital in excess of par value tells us that the shares were issued for a price in excess of the par value. If we were to take the $240,000 divided by the 80,000 shares, the paid-in capital in excess of par would be $3 per share. The other information that we're given is that the retained earnings balance is $750,000. What we're going to see next is a description of the transactions. What I'm going to do with you is I'm going to explain each transaction, what the description is telling us, and then I will go through the solution. What I've also provided you with is a hard copy of the problem and the solution so you can look at that. So on February 1st, the corporation declared a $1 cash dividend per share to stockholders of record on February 15th, payable March 1st. So right now we know that there are 80,000 shares outstanding. So if we take the 80,000, obviously multiply by $1, we're going to get $80,000 as a cash payment. On March 1st, then the payment that has been declared will be paid. On July 1st, corporation declared a 15% stock dividend to stockholders of record on July 15th, distributable July 31st. On July 1st, the market price of the stock was $25 per share. So to come up with the 15% of the shares that would be included in that stock dividend, what we would do is we would take the 15% and multiply by the 80,000 shares outstanding, and the stock dividend will include 12,000 shares. Also, since this stock dividend is below 25%, then the transaction will be valued at the market price of the stock, which is $25 per share. And then, so we've had the declaration on July 31st, the shares would be actually distributed to the shareholders of record. On December 1st, declared a $1 per share cash dividend to stockholders of record on December 15th, payable January 5th, 2017. All right. So we have the original 80,000 shares, then the 12,000 shares as a result of the stock dividend. So we're going to have 92,000 shares that will be entitled to the dividend, so that the dividend declaration will be $92,000. On December 31st, we're told that the net income for the year was $500,000. Since I'm not having you do the closing entries, we're not going to be closing that per se, and from income summary into retained earnings. However, in the T account, we're going to include that $500,000 because that will impact our ending retained earnings balance, and we will need that for the preparation of the stockholders' equity section of the balance sheet. We're also told that the market price of the stock as of December 31st is $32, and that really is not relevant for our purposes. So here are the things that we have to do. We have to journalize the transactions. We have to enter the beginning balances and post the entries to the stockholders' equity T accounts, and then prepare the stockholders' equity section of the balance sheet at December 31st, 2017. The balances for each equity account in terms of the T accounts, those accounts will appear on the stockholders' equity section of the balance sheet. All right, so let's look at the first transaction. So if we go back, February 1st, corporation declared a $1 cash dividend per share to stockholders of record on February 15th, payable March 1st. We had already determined that the amount was $80,000, so we would debit cash dividends for $80,000 and credit dividends payable of $80,000. So on the date of declaration, the corporation incurs the legal liability to pay those dividends. On March 1st, they actually pay the dividend. So then we would debit dividends payable and credit cash for $80,000. On July 1st, the corporation declared a 15% stock dividend to stockholders of record on July 15th, distributable July 31st. On July 1st, the market price of the stock was $25 per share. So that's going to determine the value of this transaction. So we're going to debit stock dividends for $300,000. So we're taking the 12,000 shares involved in the stock dividend and multiplying by the current market price of $25 per share. Common stock dividend distributable is credited for the par value. So once again, in this case, the par value is $20 per share. So we're crediting common stock dividends distributable for $240,000. The paid-in capital in excess of par per share will be $5 because the market price is $25, par value is $20, and that gives us a 5. So in this case, we're crediting paid-in capital in excess of par for $60,000 because we took the 12,000 shares and multiplied by $5. On July 31st, the shares that are associated with the stock dividend are now distributed. So we're going to transfer the $240,000 from common stock dividends distributable, so we're going to debit that account, and credit common stock for $240,000. And on the 31st, we see that entry. On December 1st, it declared a $1 per share cash dividend to stockholders of record on December 15th, payable January 5th, 2017. So we're just doing the declaration in December. And remember what we had said prior to this, is that the dividend will be paid on the original 80,000 shares plus the 12,000 from the stock dividend. So 92,000 shares will be getting $1 per share. So obviously we're debiting cash dividends for 92,000 and crediting dividends payable for $92,000.